Welcome to our special year-end edition of Wall Street Week, the show of record for long-term investing. I'm Gary Kaminsky.
This is so much fun. I'm Sandra Smith. It's so great to be here. Happy New Year.
Great to see you.
All right. Well, the Dow, NASDAQ, and S&P all with very nice gains, if you hadn't noticed, for the year. The Dow Industrials was the outperformer with a late surge after Donald Trump's big victory, and all three hitting new highs this year. Though the Dow teased us, but never quite got to that big round 20,000 mark that everybody was watching.
The big number. So what will 2017 bring for long-term investors? To our market experts, SkyBridge Capital Senior Portfolio Manager Troy Gayeski. Want to get that senior in there for Troy, and UBS Managing Director Rob Sechan. You know, Rob, as I reflect on the year, if you had just bought the S&P 500 January 1st, closed your eyes, you basically got the long-term rate of return for stocks, roughly 10%. Dividends reinvested. But we know it was not that easy. So what were the real 2 or 3 lessons long-term investors should go into next year reflecting on?
I think the first lesson that you have to focus on is don't panic. We started the year with a massive sell-off caused by Chinese policy and oil prices bottoming. Mixed data at the end of the summer caused another sell-off, albeit a little bit shorter. Brexit as well caused a sell-off. And I think the idea of focusing on fundamentals, looking beyond the immediate market noise, the immediate media noise, investors would have done well by doing that. The second thing I would say is don't confuse the base case with a done deal. Several lessons there, right? Brexit, I think markets had priced in a stay. It surprised everybody. And then the Trump election. In each case, again, not focusing on the noise, focusing on fundamentals made sense. And then the final thing that I would say is don't underestimate the central banks. There's been a lot of talk about policy reaching its limits and becoming less and less effective. And I think what they've proven, whether it be the Fed, ECB, or any other central bank, is they have had the ability to engineer commentary and policy that makes sense to the markets and essentially dumbs down vol and smooths out returns. So if you can be patient, I think you'll be rewarded.
That and remove emotion from the market. Remember how we started the year? Yes. I mean, it was the worst start to the U.S. stock market in any year ever. So people were in panic mode. But there were so many events that affected markets this year. What do you think was the single biggest event to have an impact on markets in 2016?
Well, there are really 2 that we'd point to. One is to the point that Rob made. The world did not end coming into the year. People coming into the year saw markets collapsing, oil going down, fears of a China devaluation. But the thing people miss is the probability of a U.S. recession was still very low. So we were definitely in the camp that even though markets were messy, the U.S. economy is not going to have a recession. The consumer was just too strong. So that was one thing people got wrong early on. Since then, though, we have to say it was the Trump election victory. Yeah. I mean, it's obvious, right? If you think of this country, we've been trapped in 8 years in anti-growth policies that have been very stifling to business, particularly hyper-regulatory overreach. Looking forward, you know, we're finally going to go back to an administration where we have much more regulatory-friendly policies. We're looking at pro-growth tax reform. The specter of deflation's been slayed. So we think, you know, that's been a big story, which has obviously driven markets very well since the election.
You could have heard me like a broken record during the year saying the person who is going to win this election is going to be the one that proves that they will be the most business friendly.
Exactly.
It's the economy.
The economy.
Stupid.
Imagine that. All right, as far as asset classes that were the biggest losers, what did you see there?
Well, since the election, it's clearly been precious metals and duration. I mean, that's if you think about the sea change. Midway through this year, people were worried about deflation again. They thought that the U.S. economy could still have a recession, so the 10-year was dropping like a stone in terms of the yield. You know, since the election, you've had a substantial rate back up, and all we've done is go back a little bit above where we started the year. So long-dated bonds have really gotten hammered since the election. And then in terms of precious metals, it's been the other side, right? So as the dollar strengthened, interest rates have gone higher, the rationale for owning precious metals post-election has gone down dramatically. So we'd point those out as getting punched in the face from the election outcome, and looking forward, we're not terribly optimistic for it.
All right, let's turn to 2017 advice now. Rob, you said stick with the fundamentals, don't pay attention to the noise. So if I want to do that, where should I be putting my money, and how should I do that this year?
I think you have to start with what are the questions facing markets this year, and it's what does the Trump presidency mean? What does pivoting away from easy monetary policy mean for markets? What's going to happen in China as it relates to a potential hard landing? What's the future of the Eurozone?
So answer those questions. What do you expect?
So when we look, we think there's opportunity for investors. It's hard because equities are sitting near all-time price level highs, right? So is high yield, so is investment-grade corporate, and so the juice has been squeezed out of a lot of asset classes. But we still think there's room to run in a number of areas. One, U.S. equities, the profit and economic trajectory is going to be improved by Trump's policies. We're expecting 11% earnings growth. We think from a quality, consistency, transparency standpoint, the U.S. is the safest place. Little bit contrarian view is emerging markets. Emerging markets are going to be the beneficiaries of global growth. No one likes them right now, partly because they're worried about funding in dollars. The value of your liabilities goes up. The value of your ability to service that with your currency goes down. However, we're funding differently today than we did in the last EM crisis. And so when we look at that, we think EM's attractive. We'd add to that some yield-based assets. We talked about that on this show.
Where are you looking for 2017?
Well, right now we think in complex fixed income markets like structured credit or the debt that's backed by financial service equities or financial service companies, the fundamental improvement continues and prices are very low and you have a very enormous cash flow. So we think that area offers very competitive returns.
Hey, by the way, you guys look very nice in your New Year's attire.
Thanks, Sandra. Yeah.
For Wall Street Week.
Thank
it's
you.
Only
We wanted to make sure that we were giving you the proper respect here.
I love the red carpet.
Guys, thanks very much. Troy Gayeski, Rob Sechan. Happy New Year, fellas, and thanks very much for the great insights
Happy
during
New
the
Year, yeah.
Wall Street Week, we'll be right back.